It sounds like a contradiction, but I think abundant life for me was created by living below my means. I never really enjoyed the rat race and the keeping up with the Joneses and the showing off your toys and your bigger house and even bigger house and the biggest house ever and the biggest McMansion and the biggest car. That was never for me. I think an abundant life is what I have right now, right? We live in a small house in a suburb of Portland. We have a lot of time with each other. So the abundance of time is actually more important than the abundance of stuff. And this is a very interesting quote by Dietrich Bonhoeffer. He said, "Time is the most precious gift in our possession, for it is the most irrevocable."
Hey, it's Rocky. Welcome to Richer Soul. Today's guest is Karsten, also known as Big Earn, who retired at 44 and enjoys his life on his terms. He'll share how he did it in today's episode. Imagine it's 12 months from now, and you've achieved your major life goals. How does it feel to be in the best shape of your life? To wake up energized, excited about the day? To have great relationships and friends who support you and propel you forward? How does it feel to have an excess of money, to be able to make the choices you want? To be fearless and open to trying new adventures? Imagine being connected to the universe and it providing everything you desire. It's possible over time, and your past does not dictate your future. The only thing holding you back from this vision is you. It's time to take control of our thoughts and use them to our advantage. Welcome to Richer Soul, where we achieve our dreams and bring balance to health, wealth, relationships, time, and spirituality. If you have not had a chance to listen to episodes 1 through 9, I encourage you to go back and listen to the framework behind Richer Soul and how to create the life of your dreams. You can also find all the show notes for this episode at richersoul.com. While you're there, you can sign up for a monthly email where I share the best articles I read this month, let you know about upcoming episodes, and share a little wisdom. You can also listen to coaching calls under the Coaching Calls tab. I also share the most interesting articles I read every week on Facebook at facebook.com/Richer Soul. And there's also a Facebook group where you can ask questions and interact with other listeners. Today's quote: "The reason most people do not accomplish more is that they do not attempt more. The boy who does not read good books, who does not embrace every opportunity to extend his general knowledge, has no advantage over the boy who cannot read books and who does not have the opportunity to extend his knowledge." If you get my emails, you know that I read a lot. In October, 7 books, and in November, 7 books. We'll see how this continues going forward. The wisdom I learned from others is incredible, and I hope to pass that along to you. Many times we also get the authors to come on the show and join us. Do you have a habit to improve yourself? If you could just improve 1% a day, that's 365% in a year. Even if you did 0.1% in a day, it's a doubling in 3 years. I try to do a little bit every day to move forward, and the pace has been increasing now that I own my time. My life and my work are one. Last week's action step was do something. Did you? How about adding reading to your list? Pick something. Get to moving. Inaction is going to put you into the drift and leads to a far worse outcome. We have an amazing guest today, Karsten Big Earn Jeske. He retired in 2018 at the age of 44 after a long career in academia, government, and corporate America. He previously taught economics at Emory University in Atlanta and worked for the Federal Reserve Bank of Atlanta. and Bank of New York Mellon Asset Management in San Francisco. He uses his newfound time to travel with his wife and daughter and write for his blog, Early Retirement Now, on all topics related to finance, and especially the financial challenges of early retirement. Carsten has an undergrad degree in business from the University of Bielefeld in Germany and a master's and doctorate in economics from the University of Minnesota. He's also a chartered financial analyst. Let's meet our guest. Welcome to Rich Your Soul, Carsten. It's great to have you join us today.
Oh, thanks for having me.
And I'm excited to have the conversation. I've been reading a lot of your stuff and I have a lot of questions. But
great.
We always start at the beginning. What was it like when you were growing up, and how much did your family and school teach you about money?
Right. So I grew up in Germany, and I grew up in a typical middle-class family, actually lower middle-class family in Germany. My father was a bus driver for the public transportation system in my home city. My mom was a homemaker. So we were not poor, but we were not particularly rich. And so fortunately, I got all the opportunities of a public education system. I went to finish my high school in my hometown. I even went to college in my hometown. And after college, I went to grad school and applied to places in the U.S. And I came to the U.S. at age 21 and did my grad school education in the U.S. And then afterwards I stayed here. So I've actually been in the U.S. now longer than the time I spent in Germany. So I'm a U.S. citizen now, So I worked in the U.S. until last year. Both in academia, for the government, for the Federal Reserve, and then in corporate America until last year. And then I retired, and I'm now early retired. I'm a member of the FIRE, Financial Independence Retire Early community. And my wife and I, we have a kid. She's 5 years old, and we moved to Washington State, and we enjoy early retirement here now.
So what is it that gave you the desire to create financial independence and retire early?
Right. So there was always this sense of risk aversion and very conservative finances ingrained in me. So my parents, for example, they grew up during the Second World War, right, in Germany, when everything was totally destroyed. And so they were very, very cautious and very conservative with their finances, right? Just never go into debt, always pay stuff in cash and not with a credit card. I didn't even know that there were credit cards until I came to the United States, believe it or not. That frugal and conservative mindset was always in me. And then also, I always had these fears. What if I lose my job? What if I'm not good at my job and they kick me out? What if I'm not going to make it until age 67 or 65 in my job? So that always put that fear in me to never take my income for granted, never spend all my income, never go into debt, and do the exact opposite, right? So you save money, you invest money, and always have some funds on the side that you can use if times get tough. And fortunately, that pile of money grew so rapidly that I was able to retire after, 18 years in the job market. So I graduated from the University of Minnesota in 2000 with my PhD in economics, and then I worked for 18 years, and that was more than enough to create a pretty sizable nest egg. And anyways, so I mean the high savings rate, that was definitely ingrained in me from my family, but my family knew nothing about stock investing or real estate investing or anything like that, or options trading. That is pretty much all self-taught because, I mean, believe it or not, nobody really teaches you, or at least back then, there was no really good resource to teach you about personal finance and the importance of investing and investing for the long term and investing in productive assets. and high returning assets like real estate and equities. So that is something that I basically had to learn from myself. There's no teacher, no professor, no parent ever told me about that.
And I think that's true for a lot of people. Even today, you've got to kind of learn for yourself. Granted, there's a lot more resources available to you today. But on the opposite side, there's so many resources. It's trying to figure out which ones are good and which ones are hype and making the right choices between all of those.
Right. So now it's almost the opposite. It's overload of information, right? And which one is good, which one is not. Who can you trust? What is a hype? What is a scam? It's a little bit easier today, but it's still hard for young people today to figure it out. And then, so basically the default position is, well, I can't figure it out. So I don't save and invest anything. I'll just spend the money. That's much easier, right? You get a lot of guidance in that. So there's lots of TV commercials and lots of ways to, lots of encouragements of people to make you part with your money. Yeah.
Part with your money so they can have it, right? Smart on their part. Out of curiosity, what was your savings rate when you were working?
I had only 2 major jobs in my entire career. I mean, if you take out graduate school and college, but even in grad school and college before that, I tried to have a very small savings rate, maybe 5 to 10%, just because just to get into the habit of saving. And again, that's savings of 5 to 10%. That is not saving some money and then blowing it all on a vacation or on a party. I mean, that was already saving money and investing it in the stock market with the idea of never touching it again and just see the money grow. When I got my first job straight out of grad school, I probably had a savings rate of around 25 to 30%. I thought that was astronomical back then. If you look at the average U.S. savings rate. But then my second job, so between 2008 and 2018, I worked in the private sector for a big asset management company, and there I probably managed somewhere around between 50 and 60% savings rate, and that's how much money you put aside. So if you pay your taxes, so that's already out. And then you look at the 2 big buckets, consumption and savings. So the savings is about half of consumption plus savings. So about equal amounts of consumption and savings. That makes it a 50% rate.
That's impressive. And that also means you learn to live on less, so you need less when it's time to retire. So it's kind of a double-edged sword in the more you save, the less you spend, the easier retirement becomes.
Oh, yeah. I mean, that's what people have pointed out all over the place in the FIRE community, that you get that double benefit of frugality, right? First of all, it helps you. Sorry. First of all, it helps you to accumulate assets faster. And then also your savings goal, if you can keep up that frugality throughout your life, including retirement, that savings goal is lower. So you get a double whammy for being frugal. Absolutely. Yeah.
Do you feel like you missed out on life because you weren't spending?
I never felt that I missed out anything significant. I think the only constraint I really had throughout my life was that I worked corporate jobs and I had a certain number of vacation days. So I certainly missed out in terms of I didn't travel enough when I had opportunities because, well, I had only so many vacation days. I wouldn't say that when I missed out, it's really because I didn't have enough money. So, I mean, basically what I missed out on would be driving nicer cars, but that's not really something that I missed that dramatically. So it turns out that I was actually able to live a very comfortable life without ever feeling a need to consume more. And I mean, one great indicator of that is that when I retired, nobody had any idea that was what I was doing. So I looked like just just like the middle class or maybe slightly upper middle class individual family. We were driving a decent car. We were going on vacation. I was wearing clothes that looked okay to everybody. So nobody had any idea that we were more frugal than the rest. But we managed to secretly save 50% of our income by just being conscious about the spending and not overspending on certain things. And so, yeah, I mean, I wouldn't say that I missed anything from a financial point of view. It's mostly that you didn't have the time.
And that's an important asset that we seem to forget about, which is time. And we tend to give it away and we think of it as unlimited, but it definitely is not. And so having that time freedom is a big part of it. And it's true. You can live nicely, but frugally, which is what we do. You can have nice things. You just buy them at massive discounts. And there are things that, depending on seasonality or, you know, even with cars, if you buy a late model car that's a year or two old, you still have a nice car and it's a fraction of the price. So there's dramatic ways to save a lot of money if you choose to go down that path.
Right. And that's what we did. So to the outside world, we looked like, well, if we had bought all of this stuff at full price, we would not have had a 50% savings rate.
You have a young child. What are you going to do to teach her about money?
We already teach her about money. So she's 5 years old. I mean, we tell her, well, these are things that we can afford. These are things that we cannot afford. I tell her, well, Papa has to go to work, quote unquote, right? So I sometimes do stuff at my office. I work on my blog. I do some option trading. So she will hopefully get the concept of money and earning money and the importance of getting a good education over time. I think right now she's really too young to really expose her to everything in the personal finance space. And once she gets a little bit older, we'll definitely start working on that. We don't have a fully laid out plan for that yet, but we'll definitely deal with that when it comes to it. But yeah, I mean, there's definitely we are teaching her about well, do you want to spend something now or save something for later? So we'll she's not quite there yet because she doesn't quite have the math skills yet. But in a few years, we'll definitely introduce her to the concept of saving, of interest and returns and compound interest, and hopefully that will leave an impression on her.
I'm sure it will, and you're great examples of walking the walk. So there's no hypocrisy for her to see with that, and
right,
probably will all make sense. So you retired a couple of years ago. What have you been doing? You've been traveling a lot, right? You made up for all those years without travel.
Right. And I mean, just to be sure, I mean, we did travel even when I was working, but it was usually very rushed, and you would fly for a week to Germany, and just by the time you got over the jet lag, it was already time to go back. And so what we did was, when I retired, I actually retired mid last year, so it's a little bit less than a couple of years ago. So June 2018. So we went on a 7-month trip last year in 2018. And we did slow travel, right? So we spent several months in Europe. We spent several months in Asia. We visited Australia, New Zealand, multiple countries in Asia, so Philippines, Thailand, Cambodia. In Europe, we visited France, Germany, Switzerland, Austria, Slovakia, Czech Republic, Belgium, Netherlands, Ireland, and UK. And so we did the slow travel that we could never do before, where you stay for a whole week or more in one place, and you don't even have to do something every day. So that was something that always got me when I was traveling. before, when you had to rely on your vacation days, you almost create more stress in your travel, because you try to pack as much as possible into your vacation because your time is limited. And say you go skiing and you get so upset when there's a bad weather day, when the lifts are closed. I said, oh my, I took a whole vacation days for this, and now I'm stuck here in Lake Tahoe and it's snowing the whole day and the lifts are closed, and they are robbing me of this experience. Whereas if you're traveling in early retirement and you have all the time you need and all the time you want, it's just so much more relaxing. So if there's a bad weather day, well, you just stay in, you stay home, you play with the kid at home, or you read something. You never think of it as a wasted vacation day. And we, to us, it got even so far where we said, look, if we stay a whole day in one place, so we have 7 nights, that means 6 full days. I'm not going to go explore that location 6 days in a row, right? I want to have almost like a weekend in between. You need a weekend from your travel schedule. So 1 or 2 days, we would just chill out and stay at home, maybe go to a park, let the kid run around. It would have been wasteful 2 or 3 years ago when you had your limited time allotment every year, but it felt just so relaxing. For example, we crossed the Atlantic back and forth on a cruise ship, and so that's the ultimate slow travel. So we did last year, we did the transatlantic repositioning cruise in the fall from Amsterdam to Tampa. There was 16 nights with a few stops in between, and then in between there's going to be one stretch of time where it's 7 full days you're at sea, and that seems like a waste. And nobody except retirees would be on that ship, obviously, because it's just such a long time commitment. And it was just so relaxing and so nice to have the family time together. And obviously there's some things to do on the cruise ship, even when you're at sea. But that's something we really wanted to do, to have more time with each other and have a really stress-free retirement travel.
And so we do that now. Usually we would take vacations of 2 to 3 weeks. And what we found, though, is by the time we got to 3 weeks, we wanted to go home. It just got, because it came, travel became work. It's like, well, where are we going to eat today? And what are we going to see? And what are we going to do? And I don't want to, it just was like, can I just go home and relax?
Yeah. Different people have different crossover points. So I definitely thought that last year, when we were 7 months on the road, that there came a point when I thought, okay, now it's time to settle down. It was much longer than 3 weeks. It was probably after 4 or 5 months. I definitely felt that it would be nice to come home again. But again, so last year when we traveled, we didn't even have a home. We were homeless. We had sold our car. We had sold our home. All of our stuff was in storage. So our home was basically a storage unit in Hayward, California. And that's where we would change our clothes if we were ever in the area again. And so it's a little bit easier to do long-term travel and not feel homesick if you don't have a home. But then, so this year we bought a house. We now settled down in Washington State, just outside of Portland, Oregon, just across the river. And so this year we traveled, quote unquote, only 4 months. And so we had already settled in and become comfortable in our home here. And I have to say that it took about 2 months for me to start thinking again, it would be nice to sleep in my own bed again. It would be nice to have my home and my home office and the garden and everything. And different people have told me different time frames. Some say 1 month, 6 weeks. 8 weeks. Definitely. After 2 months, I also felt that there was the urge again to fly home again.
And as you said, it's different for everyone. I do know that we gave up on 1 week vacations long ago because it was literally by the time you fly somewhere and then the rush and hustle bustle, and then you fly home and then you feel like you need a vacation from the vacation. And so we would always do the 2-week vacation minimum. And if we had a longer travel distance, then we would go for 3. And that seemed to work out for us a nice balance. We'll see how it goes going forward. I don't know what my wife has plans to go all over the place. I'm like, figure out what you want to do and let's plan it out well instead of just kind of going. So we'll see how it goes.
Yeah, that's smart.
So when you retire early, you have to make your money last for a long, long time. And that creates issues. I mean, because one of the biggest things that I've heard, depending on how you retire. So people who retire with real estate, every month cash is coming in and they don't mind spending it. But when you retire with a stock portfolio or paper assets, one of the issues that comes up is, hey, I'm making my pot smaller. And so there's fears around that. And sometimes it leads to a scarcity mentality. So how have you been able to handle that? And what was your plan for how you were going to do this?
That was always on my mind. And I thought, okay, well, I'm just going to read up on something. And there's probably one academic paper that I'm going to read in 1 to 2 hours. And that will inform me and tell me everything I need to know to make the money last. And lots of people probably thought about this before. And when I was planning this, obviously. So maybe anywhere between, say, 5 years before retirement, that's when I started really thinking about this. And it turns out there's not really that much useful information out there, right? So there's the Trinity study and Bengen's research that established the 4% rule. So you can quote unquote safely withdraw 4% of your initial portfolio, then adjust that for inflation. And no matter really what happens to your portfolio, it should really last you 30 years. And the problem is my retirement horizon is a lot longer. So there would have been plenty of cases where the 4% rule would have lasted you through 30 years. But towards the end, you were basically flying on fumes, right? And you were almost running out of money, and you just made it to the 30-year target line. And so I didn't really trust any of the research out there because it didn't really apply to me, right? And a lot of the work is also done where they say, well, talking about probabilities, right? They said, well, you have only a very small probability of running out of money. And then I looked at the way the probability was calculated. So you look at the number of failures and you divide by the number of attempts, right? So they look at the different retirement cohorts that ever lived since, I guess, 1926 or so, when their simulations start. And then they look at how many failed and how many succeeded. And the problem with that number is, of course, that you are padding that denominator with all sorts of cohorts that started at times when stocks were not as overvalued as today, right? So even the probabilities, even if you are a 30-year horizon retiree today, I would find a little bit risky looking at the 4% rule, looking at this unconditional probability. I'm more interested in the probability conditional on retiring today when equities are really expensive, bond yields are really low. So the analogy I always use is that so you are looking at the probability of getting into a traffic jam, right? And that is maybe only 2 or 3 or 4 out of 24 because you have maybe 2 hours of rush hour in the morning and 2 hours of rush hour in the evening. So your probability is only 1/6 of getting into a traffic jam. So if you spread this over 24 hours, so which may be the right probability if you have absolutely no clue at what time you are leaving. But if you already know that you're leaving at 4 p.m. in the afternoon, the probability of a traffic jam just went up. So you cannot use that 1/6 number. You can probably say you have a close to 90 or 100% chance of getting into a traffic jam. And so that same logic also carries over to the the whole safe withdrawal analysis, that you have to not just look at your historical simulations and then take the average over all possible starting times. You have to also look at what happened during times when equities were similarly expensively valued, and what happened during times when bond yields were really low. And so all of this is something that I played with in my mind. And so I basically say, okay, well, nobody else is doing it the way I like it, so I have to do everything from scratch myself. So this is one of the reasons why I started my blog, for example, and then I wrote my own research on safe withdrawal rates. And initially, I have to admit, it was a little bit, to poke fun and criticize the 4% rule. But I actually view it as not really a negative contribution. It is actually a positive contribution and something to encourage other people, because I was amazed that, well, maybe the 4% rule seems really unsafe, especially considering expensive equities and something like a 50 to 60 year horizon for myself. But it turns out you don't even have to go much below 4%, and then you make it work again. Because there are tons of people out there that tell you, oh, because you have such a long retirement horizon, you will never be able to pull this off. And I mean, it turns out that even if you had started at the worst possible times in 1929 or in the mid 60s or in the early 70s, just a slightly smaller withdrawal rate would have gotten you through even the worst possible return patterns in history, and even over a 50 or 60 year horizon. So I was amazed by that. And I mean, that was actually one of the reasons why I was able to retire, because if I had found that you can't make the math work and there's way too much uncertainty in it, I would have never done it. But so this almost, I mean, I used this to give me the confidence to really pull the plug and leave a job that was actually paying pretty well and that wasn't too awful. So that gave me the encouragement to actually retire. And right now, when in retirement, it also gives me the encouragement to spend comfortably and spend confidently, that I don't constrain myself, because that sometimes happens when people retire and then they live like total misers, because they say, well, I can't touch ever the principal. I can only live off of my dividend yield and my paltry interest. I mean, try that today, right? That's not going to give you a lot of income. So you have to have the confidence to retire, and then also you have to have the confidence that in retirement, when you have the swings in the stock market, I'm not even talking about this summer. I mean, that is nothing. That is total peanuts. But even last year in the fourth quarter 2018, right, there was a lot of volatility. Market dropped by 20%, and well, I was sleeping very soundly, and I had no worries about running out of money, right? Because I knew my portfolio can make it through another Great Depression. So what is this? 20% drop is nothing.
So what you're basically talking about is sequence of return risks, right, which is a big thing. And I think it's a principle a lot of people don't understand. The second thing is you're looking at 4%, which I think a lot of people don't even look at such a low withdrawal rate. I think a lot of people think of the stock market's making 6, 8, 10%. I can withdraw 8% per year. And the reality is you can't. You won't make it. And the worst part is you're going to be old at that point when you run out of money. And then what do you do when you're old and out of money? So are you withdrawing at a 4% rate, or have you chosen a lower rate?
Right. I mean, funny thing is, there are irrational people on both sides of the spectrum. There are also people that say, I'm going to withdraw 1.8%, and so then I have to roll. I would say actually everything under 3% seems way too conservative. But back to the point you raised. That's there are also people that are way too optimistic, right? Because they look at stock returns and they say, well, stocks return, as you say, 8, 9, 10% over time, and can I withdraw all of that, right? And so first of all, these returns that are quoted usually in the media, and say Dave Ramsey has some numbers floating around there, they are usually nominal returns. Right. So that means even if the stock market were to return 8% year after year after year for sure, and you could perfectly hedge that, and you start withdrawing 8% year after year after year, you would eventually, you would draw down. So your withdrawals would then be eroded by inflation, right? And of course, right now we have only about 2%, even a little bit under 2% inflation. And you will never feel this in 1 year over the other. But after 30 years, you might, right? Because 30 years of inflation at 2%, that definitely erodes your purchasing power. If you have a longer horizon, say 50 or 60 years, as in my case, so my wife also retired, obviously. She was in her mid-30s when we retired. And she could live until mid-90s. So after 60 years, any kind of inflation, whether it's 1.5 or 2 or 2.5%, that's definitely going to do a trick on your portfolio if you erode your purchasing power by something like 2% a year. And then historically, inflation was even higher than that. So I would always caution people that, the stock market return over the very, very long term, if inflation adjusted, was a lot less than your 8 to 10%. So we are more in the region of 6.7%. So it's just under 7%. And so a lot of people don't realize that inflation plays such a big role in retirement, especially over so many decades. And then, of course, as you said, there is the issue of sequence risk, right? If you have paper assets, even if your return over the entire 30-year horizon or 50-year or 60-year horizon was pretty decent, sequence of return risk says that if you withdraw money, it's not so much a matter of what is the average return over that long stretch of time. The rate of success depends very crucially on the early years of those returns, because that's when you start withdrawing. And so imagine you retire at the peak of a recession, at the peak right before the recession and the bear market. So this is the peak of the stock market. And then the market drops and you still withdraw money regularly because prices are depressed. You're now withdrawing and liquidating more shares, right? Because you're withdrawing the same amount at a lower price, so that means you're withdrawing more shares. So in that sense, sequence of return risk is the opposite of dollar cost averaging, right? As a saver, you could make the case that if the market drops and then quickly recovers, that might even be good for you, because then you dollar cost average through the dip and then you make the money back on the recovery. But sequence of return risk for retirees, when you start withdrawing money, is the exact opposite. You withdraw more when prices are down and you withdraw fewer shares when prices are up. So your rate of success depends a lot on those first, say, 5 to 10 years of your retirement. And if you are unlucky and you have very bad returns during that time, even if the market eventually recovers again, and it always recovers, right? You can look at the historical chart of the S&P 500. It always reaches a new high eventually. But the problem is if the recovery is not fast enough, then you can actually run out of money in retirement, even though your return was high enough that on average it would have supported a very generous retirement. It just so happened that early returns were so bad that it sent your portfolio into distress and will never recover from that.
And yet you retired at essentially pretty close to all-time highs, both for stocks and bonds, and we'll see what happens. But so let's put this in perspective for listeners. Your wife retired in her early 30s, and she's looking at a 60-year time horizon. So if we were to take a 60-year time horizon and say, what if I retired in 1959? And I was still alive today, what would be my difference in cost of living? And I know for my parents, they went through that. They retired in the early 90s. And in the early 90s, interest rates were still 8, 9, 10%. And so they were heavily invested in CDs and you're getting 10%. Well, over 20 years, inflation kicked in and their income went from 10% to 2%. So their income went down 80%. And the cost of living probably, whatever it went up. So that's a dramatic shift. And I know I was reading one of your blog posts and you talk about, the market peaked in 2000 and it wasn't until 2013 that it hit that number again. That's a 13 years of essentially zero.
Right. And it's zero and it was below. So let me clarify that, because if you look at the S&P 500, it actually reached a new peak in 2007. It just barely got above the old peak. It was in each occasion, it was around 1,500. And then on top of that, you also got the dividend investment, right? So it was even a little bit higher, and so in that sense, it reached the peak again. But again, it didn't take into account inflation. If you subtract inflation, so you take the S&P 500, you add dividends to make it a total return index, but then you subtract inflation, it turns out that the market never recovered even in 2007, and it took until 2013 for the S&P to reach a new peak. So that's why I tell people, because some people sometimes ask me, well, why don't you just do 100% equities in retirement, right? It has the highest expected return. Why care about bonds? Especially bonds right now they pay very little in interest, not even inflation right now. And so why don't you just do 100% equities? And then I say, well, yeah, I mean, the problem is, in real inflation-adjusted space, you would sometimes have these drought periods for equities that last for a decade or longer, sometimes even 2 decades. I think there was one stretch where you had a 20-year time span with zero real equity return over a 20-year period. So that means if you take any period like that, say that you take that 13-year period and you start withdrawing during that time, and your equities, not only do they not grow, but they were also below that initial level, and you withdraw more shares during that time. So I mean, 100% equity portfolio would have totally failed if you had started in 2000. So that's definitely a cautionary tale. Especially it's a cautionary tale for people who say that, I have a very heavy equity portfolio, but I just keep two or 3 years worth of money market accounts on the side. So if equities drop, then I can get through the storm with my money market account. And then I show pictures. Well, you need actually 12, 13 years. There were cases where I think it was about a 20-year stretch where equities were underwater. And you cannot have a cash bucket that lasts you that long. And people make the mistake. They look at, the equities go down for 2 years, but then they start recovering again. And I always say, it's not enough that you went through the trough, right? You have to go from the peak to the trough, and then from the trough, it has to go up again, and it has to not just catch up with the old peak, it also has to catch up with the old peak plus inflation. And that might take so much longer than any cash bucket will ever last you. But then again, I mean, I also want to point out, because you brought up the historical cohorts that retired when interest rates were a little bit higher. Yeah, absolutely. If you had retired in the late 90s, for example, interest rates were pretty high, right? The nominal bond yields were somewhere around, I believe, 6% or so, or over 6%. You could have put together a TIPS portfolio, and TIPS yields were at over 3%. I think they were close to 3.5%. So that means you could have sustained a 30-year retirement with a 3.5% real withdrawal rate and maintain your capital. So if you were happy back then to deplete your capital in the late 90s, I think you could have gone to something like a 5.5% withdrawal rate. Absolutely no risk over 30 years. No risk of running out of money, completely inflation hedged, and you could have had a very comfortable retirement. You don't even have to worry about stock volatility or interest rate volatility. But the problem is right now you can't, because real yields are pretty much zero. And that means you can basically, I guess if you deplete your capital, then you can afford a 3.3% withdrawal rate if you have a zero real yield on your bond. So you slowly deplete your bond portfolio over 30 years. And if it's over 60 years, if there was a 60-year TIPS with a zero yield, then it's basically 1 divided by the number of years. That is your safe withdrawal rate. So bond yields now are so low that you can't really do that perfectly hedged portfolio where you build a CD ladder or a bond ladder that exactly hedges exactly your cash flow over time in retirement. So you have to, as crazy as it sounds, so because the bond yields are so low, it's you have to go into equities. You have to do real estate or equities because bonds just don't do the job anymore for retirees now.
They don't, but I think people don't realize is that if you bought bonds in the late 90s, from the late 90s to now, you would have made a killing in the bond market. You would have made tons and tons of money. And I don't think people realize how much money was made in the bond market over that last 20-year period.
Right. And but the point is, so you went from bond yields of 6% to now 1.5%. So it's not like we go from 1.5% to minus 6%, right? There's
Correct.
now a limit of how much you can get. So first of all, the yields are low to begin with. And then there is some limit of how low they can go. Sure. I mean, you could argue that, well, maybe if the 10-year yield goes to zero again or below zero, it is below zero for a lot of other economies in Germany and Japan and everywhere. But I mean, there's some limitation to how much upside potential you have with bonds right now. So if you hold bonds right now, you hope for a bigger fool who buys it from you in the future, right?
We'll be back with our guest in a moment. I'm thinking of starting a paid mastermind group. We've talked about the power of being in masterminds before on the show. The group would meet every week for 75 minutes with the focus on making us better. As we talked about in the intro, small changes add up over time. The focus would be on creating harmony in all areas of life and the integration of life and business success. What would it be like for you to have your own private board of directors that are there to help you move forward in every area of your life? Now, masterminds are a give and take. You've got to show up and help just as much as you want to be helped. The more you bring to the table, the more that you get from the table. It's that simple. If you're interested in learning more about joining a paid mastermind group, just email me or use the link in the show notes to get on my calendar. It's Rocky@richersoul.com. I'd love to hear from you. Now, let's get back to our story with Big Earn. Very true. So as we look at this 4% rule, I wanted to talk about the impact of investing fees. Because if you think about it, if I'm paying a 1% or 2% fee to my broker for investing my money, and I've got a 4% safe withdrawal rate, he's literally taking a quarter to almost a half of your money in fees.
That's the scary part. I mean, if you do the math, right, and you already paid fees during the accumulation phase, and then you knock the fees off of your withdrawal rate, because that withdrawal rate was done off of an index with zero fees, right? And you get some astronomical fees that pile up to, so you potentially pay more fees than you get out as a retiree over time, which is just absolutely insane. So that is obviously one of the reasons why in the FIRE community there are a lot of people that say, well, we just do the DIY investing and we don't want to pay an advisor for fees. We want to keep really close control on where we invest the money. We don't want anything actively managed. Of course, I mean, what the active managers are going to tell you, well, yeah, we charge you 1% fee, but we also do 1.5% better. So there's still a net benefit for you. I'm doubtful that I think if you are lucky, they charge you a 1% fee, and they do 0.5% better. So it may mean that your loss is really only a 0.5% point and not the full percent point if you're lucky. But in the worst possible case, it may actually they charge you the fee, and that is just purely a loss, because before fees they just match the index, and then after fee you stand to lose a full percentage point. And that's something. So again, it doesn't reduce your withdrawals by 1%, but because you withdraw 4% and you take 1% of that 4%, that's actually 25%. That's what a lot of people don't get when they look at these fees and says, oh, it's only 1%. No, I mean, this talking about percent of percent, that you almost need a license to talk about percent of percent, because there's so many different ways of getting that calculation wrong. So it's actually exactly as you described it. So you have to subtract that percent point for the expense ratio from the safe withdrawal rate, and that might have a huge impact on your retirement finances.
A very huge impact, 25 to 30 to 50%, which is quite a bit. So now you're doing something interesting in your retirement, because you're doing a different type of investing, and we haven't talked much about options at all on the show. I've played around a little bit in the past, but not a lot. So let's just talk a little bit about options trading, what it is, and what are the opportunities there?
Right. So, an option is a financial derivative. So, there are two types of options: call options and put options. And then in each case, there's obviously a buyer of the option and a seller of the option, right? So you don't create something out of nothing, right? So if you look at the profit and loss of the buyer plus the seller, it is pretty much zero, right? Because one person gains, the other one loses. And so I view options as a type of insurance, right? So for example, you can buy a put option, and say, imagine right now the S&P 500 is at 2,900 points, and you can say, well, I would like to limit my losses of the S&P 500. If it were to drop below 2,800 points, then I would like somebody else to cover those losses beyond 2,800 for me. And so that means you would buy a put option, and you would pay a premium for that. And so it's a payoff profile where if the S&P 500 stays above 2,800, then, well, you lose your premium. But if it drops below 2,800, then somebody pays you to make up for the losses. I mean, that is literally an insurance contract, right? So it's like my car insurance, liability insurance. I pay a premium if nothing happens, and then if I have an accident and the damage goes above $1,000, then dollar for dollar the insurance company pays me everything that I lose above $1,000. If the damage is $5,000, they pay me $4,000. If the damage is $15,000, they pay me $14,000. So that's a bit like a put option. The people who buy the option, they buy the insurance. In that case, if it's a put option, and the people who sell that put option are, a bit like the insurance company. And so what I have figured out, and again, I didn't figure that out myself. There's actually some academic literature on that. Just like in every insurance business, people tend to overpay for insurance, because people are sometimes a little bit myopic. They have a loss aversion, right? That is a very recognized and very famous behavioral bias in finance. And so think of that as, people go to Best Buy and they buy a flat screen TV, and then at the checkout they ask you, hey, do you want to buy an extended warranty for this? You only pay this much, and if it breaks down, you don't have to pay for the repair. And people say, just for the peace of mind, I'm going to sign up for it, even though it's a really, really bad idea to buy extended warranties. And then even for the car insurance, I'm not saying that car insurance is a bad idea, but in expected terms, you very, very likely you pay more for that insurance then you get out in expected terms. And it's only because it hedges against some catastrophic losses. That's why you have insurance. So it's the same with selling insurance on the S&P 500, which means you sell a put option on the S&P 500. The people are willing to overpay for it. And the reason is that everybody likes the upside potential of the S&P, and everybody wants to avoid the downside, right? And so there's more demand for avoiding the downside, and the people that are selling these options get this very unattractive payoff, this very unattractive return profile, because it means that no matter what the S&P does on the upside, I only make that small premium. But then when it drops, I could potentially pay out in the case of just like a car insurance or like a casino, right? There's that big payoff to somebody in a very unlikely scenario. But because this payoff profile is so unattractive, it means there's a premium that has to be paid over and above the expected value, and that's in a nutshell what I'm doing. So I'm selling S&P 500 put options. I do this multiple times a week. I do this with very short-term expiration dates. So I normally sell an option, say on Monday, that expires on Wednesday, and then on Wednesday, 99% chance that option expires worthless, and if it doesn't, I have to pay out something, and that's hopefully less than all the premiums I collected in the other 99 or 100 occasions. And then when that option expires, I sell another option on Wednesday that expires on Friday. And so I do this very diligently. So it has a very nice return characteristic. Is a relatively stable income, which is something that I enjoy in retirement. It may not be the best strategy for people still saving for retirement. So there you probably still want to capture the upside and you still want to hit home runs. But once you won the game, you're in retirement. I have the net worth to support our retirement. So now I'm looking more at the stable income. And a lot of people ask me, well, that doesn't really sound right, because now you have a lot of downside risk, right? Because in retirement, wouldn't you want to be the buyer of a put option? And I always say, well, it all depends on what are the expected payoffs of these transactions. And so I found this little niche for me where I'm trading these very short term and in my view very overpriced put options. And since they're overpriced, it means I want to sell them.
And I think this is where people, because I've heard horror stories of people who do this. And I think part of it is you're actually doing something very different than they were. Number one, you're limiting yourself by having 2 days, right? 3 days. So the chances of massive change in a 3-day period are extremely minute versus if you did this for a 30-day period. Your chances go up dramatically. I know of people who've been bankrupted by this. I know people who've lost hundreds of thousands of dollars in a single day because it is a highly leveraged strategy. So it's not something you should do without understanding the risk of it. And unfortunately, there's a lot of people out there who are selling this as a get-rich-quick scheme, where you have no money and now you have money because someone gave you money. They don't understand the opposite side of that, which is you are the insurance company. And when the crash happens, and if it's a $35,000 car, you now have to write the check for $35,000.
Oh yeah. And I've had days like that. Yeah, exactly. Exactly in that ballpark. Absolutely.
So let's just talk about that. So when you've had a bad day, how long does it take to recover from a bad day?
I think that, so if I have a bad day, there is this thing in human nature that we are so enraged and so disturbed by that 1 day loss. And there's two ways you can react to that. I guess there's three ways to react to that. And two of them are really bad. And one of them is the right way. So the first bad way is to double down, right? You lost something today and you say, okay, the market is wrong. I'm right. I'm going to double down on this. And that is definitely not the right way to do it, because we have seen some weeks where the market is down 8 days in a row, right? And if you lost money from Monday through Wednesday, right, it's possible that the market keeps losing, even though there's a little bit of a self-regulation in this strategy. So, for example, if you have an event like February 2018, or there were some other cases in 2015, 2016. I've been doing this since 2011. Once you have a pretty catastrophic loss, like 2018, where I lost probably around 3 months worth of option premiums. So 3 months of work where I spent a few minutes 3 times a week. That's all out of the window in one single day. Because that loss was so catastrophic, the market is efficient in that sense that if you have such a catastrophic loss, then also the insurance premium going forward would go up. Right. So it turns out, even though the market kept dropping during that week, I had sold options that had strike prices that were so far below the current market value, because suddenly everybody is extremely scared. And so option premiums go up. Or if you want to sell for the same option premium as before, you would sell at a strike price that is so far away from today's value. So far below the stock index value today, that there's a chance that it gets there, but it is actually a relatively low chance. So think of that as I sold insurance to somebody. They had a car wreck, and the next insurance contract I sell to them it's the same premium, but it has a fantastically higher deductible. So they may have another car wreck next week, but I just raised their deductible to $30,000 from $1,000, and so and the same working goes on in the option market too. So if you have this week like February 2018, implied volatility goes up. That means option premiums go up. That means I can sell the same contract as before, but for a lot more premium, or I can sell a much less risky contract for the same premium as before. So it actually turns out, for example, I made money writing options in the fourth quarter of 2018, even though the market was down by 20%. It just happened that the downdraft is slow enough that once you make a little bit of a loss, the future options you write are so non-risky because they're so far out of the money. So the strike price is so far below the current value of the underlying that even if the market keeps dropping, I'm not going to have any future losses. So, anyways, but back to the three behaviors. So the first one is you never want to double down and then take astronomically higher risk after you had one loss, because that's how people got wiped out in the past. I'm pretty sure that's what they did. This is not something that came out of the blue. This was probably a bad reaction to a loss, and then people double down. The other thing you don't want to do is you have one loss, and then you say, okay, I can't stomach this anymore. I throw up my hands. I don't want to do it anymore. Because my personal experience is that after you had a big loss, is actually, markets are efficient in that sense. Then volatility is high and the premiums will be high. That might actually be a good time to keep doing this, because it may take a lot of time until you have the next loss. And after one loss where you paid out something, there is actually a relatively smaller chance of getting another loss. I'm not so worried about having another loss after a big loss. I'm more worried about I've been running this strategy for many months, and I've always made money with the options, and I never suffered a loss. And then everybody's getting complacent. Implied volatility is really low. I'm more worried about that. So don't overdo it. Don't double down. Don't give up. And what you want to do is the middle path. You just keep doing what you're doing. stoically, stubbornly, and it's an active strategy in the sense that you have to do something multiple times a week, but it's passive in the sense that I never really change path. I do the same thing and I keep doing what I'm doing, and that has served me pretty well. And that I have to tell you, that takes some training. You have to get over that, especially. You have to get over that feeling of the market is wrong, I'm right, and I'm going to double down. That will definitely wipe you out. And I have some case studies on my blog where that backfired. There was a company out of Florida. They were doing this for clients, and they did this not on equity index options. They did it on options on commodity futures. Which is, again, that's another level of risk and uncertainty. And they got wiped out over actually a pretty garden variety move in natural gas. And looking at what little move it took to wipe them out, I had the suspicion that they had some smaller losses before, and they didn't want to end the year on a bad note, and then they doubled down on this, and they thought they could make it back, and of course they couldn't, and it wiped them out over just a 3 or 4 day period.
Like I said, risky.
Yes.
The question I ask is because when I look at the put strategies, and from what I understand in the options market, the majority of money is made selling puts. Is why not buy a put? Why not sell a put and buy a put below it?
Oh, absolutely. You're basically doing a spread trade, right? As a credit spread, or that would be one route because you would hedge the extreme downside. And so there are pros and cons. I like the idea. I've never done it, but I like the idea that you hedge the extreme downside. So that would be basically hedging the complete bankruptcy of your portfolio. If the market were to drop by 80% in 2 days, then you'll be wiped out if you have a little bit of leverage in that strategy. But it would also diminish your premium you get every week, right? So I would, and this is what you said. You want to have, you just don't do this kind of strategy willy-nilly. You have to have basically, I have my little risk model, and I know how much risk I'm taking. I have all the option math implemented in my spreadsheet, and I know what the delta is and the gamma and the vega and stuff.
And don't do this unless you understand those terms.
Right. So you have to make, but even that, is obviously based on some assumptions, right? And I look at, for example, you can use the VIX implied volatility because that's based off of longer dated options. So because I do only the 2-day options, the VIX is not really such a great indicator of what is underpriced and overpriced relative to the implied volatilities of the options I'm trading. Yeah, so I'm definitely, I have my own little, I create my own little short-term VIX for myself. That's I have some proprietary models and thought process in that. I used to work in finance, and I tried to propose this to my employer. Hey, we should offer this as a product, and they said they didn't want it because they said it's too risky. So that tells you something, right? So I used to work in asset management. We used to manage portfolios for pension funds, endowments, sovereign wealth funds. And they made a good point. Look, it's a reputational risk, right? If we do this and we offer this, we're going to enhance, we're going to get this great yielding strategy that gives you stable cash flow, and we risk manage this. Yeah, but if you drop by 20%, there would be so much reputational risk. Whereas, if my portfolio were to drop by 20%, I would have to explain it to my wife. But my wife is more forgiving than the average customer. And then not only that, right? This could be a customer that is invested in some other products that are the real money makers for the company. You don't want to. That's what the reputational risk is. So it's so I offered this. and my employer wasn't very impressed with that. They were impressed with the thought that goes into this, but they're not very impressed with the return profile. So this is yeah. So it actually turns out it's a strategy that's good for personal investors in retirement that already got their net worth target. And everybody is worried about a 10-20% loss. I think I try to keep it under 15%. So I say if we have a repeat of the worst possible outcome in history, I would like to limit this to a 15% loss. It's actually 20% would already be a little bit above my comfort level. And by the way, so I'm running this portfolio with about 35% of our financial net worth. So that's the max I'm willing to run this, and the rest of the portfolio we have 55% in just regular index fund, mutual funds, ETFs, and then 10% in real estate funds. And so I mean it's 35%, and I lose 15% of that. It's still not a catastrophic loss in the big scheme.
No, you've thought it through, and that's the important thing. Think through these things and don't do them without knowledge, because there is risk, and understand what you're investing in and what the ups and downs of it are, and the pluses and minuses. And I don't think enough people spend the time to do just that. So I always like to ask people for an action step. What is something people could do this week to move forward in their life?
I'm more of a finance geek, so I'm not going to tell you anything too philosophical. So I'll do something about finance. I think automate your savings. That is, so a lot of people, they have to get over this hump to get their retirement savings, or their finances in general, but especially their finances in order. And there's always a reason not to do it now. And it doesn't even take a lot of time, but yeah, I mean, automate your saving, right? Automatically put X percent of your salary into your 401k plan, or automatically put money into a Roth IRA every month. It doesn't, so because $6,000 maximum contribution sounds like a daunting number. And when do you have $6,000 lying around? Well, why don't you do $100 a month, or a little bit more than $100 a week? And a little bit more than $100 a week will get you to the $6,000 for your Roth IRA, and you don't even notice it potentially.
That is very true, and that is kind of the secret to what created financial independence for me. Was I automated my savings, and then it just happened, and I didn't have to worry about it, and the rest was history.
Right.
It's time to learn the secrets of life. What's your secret to living an abundant life?
It sounds like a contradiction, but I think abundant life for me was created by living below my means. So it sounds like a contradiction, but I never really enjoyed the rat race and the keeping up with the Joneses and the showing off your toys and your bigger house and even bigger house and the biggest house ever and the biggest McMansion and the biggest car. That was never for me. I think an abundant life is what I have right now, right? We live in a small house in a suburb of Portland. We have a lot of time with each other. So the abundance of time is actually more important than the abundance of stuff. And this is a very interesting quote by Dietrich Bonhoeffer. He said, "Time is the most precious gift in our possession, for it is the most irrevocable." And so everything else is replaceable, and all of the material stuff that just depreciates anyway. But the time is the stuff. You want to have an abundance of time with your loved ones. You want to have an abundance of time to do things that you like to do, like reading or blogging or hiking or skiing. So for me, it was never an abundance abundance of stuff, it's an abundance of time. And because that is the one thing that is definitely running out over time.
And I totally agree with you. I don't think we focus enough on time, and we give it away too easily when it is far more valuable than we realize. What's one thing that you learned later in life that you wish you would have learned sooner?
So I think it's taking risks. And you can apply that generally to life in general, but I want to show you the equivalent for financial planning, right? So sometimes I ask people, and I think in the beginning I had a little bit of that mindset too, right? You are too risk averse with your portfolio, especially when you start out. I mean, you talk to people, millennials, and they say, I never want to invest in stocks again. I lost so much money in my 401k in 2008-9, and I ask them, well, how much money did you lose? And they say, oh, my portfolio went down from $12,000 to $6,000, and I've had enough. I'll never invest in stocks again. And of course, what they don't realize is that $6,000, as a percentage-wise, that's a big loss. But in terms of considering how much runway you have with your career, how much cash flow is going to come back into your 401k over time, that is minute. That's even a rounding error. That's less than 1% of all the money that you'll ever put into your portfolio. And so don't stress out over short-term risks because the bigger risk is actually not investing in stocks and missing out on the rally. So the risk is not taking risk and playing it too safe. I think in general I did it okay, right? Because I took 2 large risks in my life. I gave up my life in Germany and basically I came from my German university and came to the US for grad school. So I could have had a much easier and more relaxed path if I had stayed in Germany, and I picked this uncertainty to come to the US. And I also, I gave up my safe government job at the Federal Reserve and went into the private sector in 2008. And I went into asset management in 2008. So that was right before the crash. And so I took some risks already, but I think there were a lot of other places where I was too cautious and too meek and too conservative. Where and even if I had failed, I mean, what is the loss anyways, right? You lose maybe 1 year of your earnings, or 1 year, not even 1 year of your life. But you might even consider this an experience that teaches you how to do it better next time. So it's a falling forward. This is the whole concept. And I mean, both in life and in your portfolio, we are sometimes way too conservative, and we think something is a big risk, but it's such a small risk in the big game. When you look at what is your total lifetime earnings potential, what is your total lifetime career path, so it applies both to finance and to life in general.
Absolutely. And our last question is, what one piece of advice would you give for your younger self?
Well, I mean, it's related to the last item, right? You take more risks, but I definitely and the other advice I would give that I could have already started with a higher savings rate in my first job, and I think I also fell a little bit in this keeping up with the Joneses thing. I mean, as I said, my savings rate was about 25, maybe maximum 30%, but there were definitely a few expenses that were really over the top, and so in terms of cars and some other nice shiny gizmos, and you do this to impress other people, and don't try to impress other people. I try to impress myself and stay frugal. I probably could have been able to retire a little bit earlier if I had been more frugal earlier, but I mean, it still worked out okay for me.
That it did. People are probably envious. If people would like to find you and connect and read your work, what is the best place for them to do that?
Yeah, go straight to my blog. It's called earlyretirementnow.com. It's just one long word, earlyretirementnow.com. You can see my blog articles there. I think I publish about every 2 weeks or so. There's a lot of work on the safe withdrawal rate there. But you can also search by topic. So if you want to read more about the option trading stuff, you go to derivatives, obviously, and then you see everything I've written about the option trading strategy or derivatives in general.
Well, thank you for sharing. It's been a pleasure having you on the show. What would your life be like if you could retire early and do what you loved every day? Creating a lifestyle business that you would do even if you didn't get paid is a lot of fun. Have you ever thought about what it would look like for you? It's possible. And this week's action step of automating your savings is how you get to financial freedom faster. It's what made me so successful. It's simple and easy to do, and over time, you just increase the amount. You don't have to start at 50%. You can start at 1% and go to 2% and 3% and 4%. And the faster you take those incremental steps, the faster you will get to a very high savings rate. It might take a couple of years or maybe even a decade to get to 50%. But isn't that better than decades of nothing? If you're still listening, you must have liked the episode. So please share it with a few friends. It can start a great conversation, and I would really appreciate it. You can also connect with me on Facebook, on the Facebook page, or the Facebook group for Richer Soul. What's preventing you from moving forward, and who are you putting on your team to help build the life you deserve? Taking no action creates a far worse outcome in life than trying something and failing. Can I help you achieve your goals through coaching and accountability? Just email me. We can start with a short chat to see if we're a good fit for coaching, or just use the link in the show notes to get on my calendar. For many people, one deep session allows them to take a giant leap forward towards their dreams. You can always get me at rocky@richersoul.com. I'd love to hear how you're doing and how the information I've shared has helped you. And don't forget about the mastermind. Thanks for listening. Have an abundant week.